And on Thursday, MBS were down another 30 basis points in the morning. Jeez, every day, rougher than last. Neither of this morning's reports were great for bonds. Q4 is ancient history, but any indication of higher wage growth hurts. Jobless claims data is very timely, and anything under 200,000 suggests full steam ahead for the labor market. Bonds were already weaker overnight as overseas sold steadily. From a headline perspective, the higher Eurozone inflation numbers seem like they should have hit bonds harder. But again, the selling trend is a very gradual overnight. The focus now is on how much higher interest rates might go in the US and the Eurozone, with swaps markets now pricing a peak Fed policy rate of 5.5% in September, and some betting on 6%. US 10-year yields, the main reference rate for global cost of capital, rose 40 basis points in February and are consolidating their rise past 4%. The market is digging in deeper to yesterday's ISM data. The index was in contraction, which is good for inflation, but the prices paid component was up, which is bad for inflation. Plus, inflation data out of the Eurozone came in hotter than expected. Fed's Bostic and Kashkari spoke yesterday, expressing concerns over the strong jobs and the high inflation, once again reinforcing more hikes and no cuts this year. Even though several other unofficial labor measures like JOLTS and ZipRecruiter show softening, jobless claims came in at negative 2,000 to 190,000. Another reading below 200,000. Continuing claims fell 5,000 to 1.7 million. U.S. stocks snapped 2 days of losses after the Federal Reserve Bank of Atlanta President Raphael Bostic said the Federal Central Bank could be in position to pause rates sometime this summer. Treasury yields stayed elevated. Traders ditched their low conviction moves toward the middle of the trading day, pushing the S&P 500 higher. The NASDAQ 100 also jumped as investors considered Bostic's comments somewhat dovish. Both indexes shrugged off the losses they suffered earlier after data signaled continued resilience in the labor market and supporting a case for Fed rising rates. At the end of the day, we were down 19 basis points, but pushed the 5.5 at 99.2. The S&P was up 30 points, and the 10-year was up 5 basis points. At 99.2, it's basically pushing us completely off of this range, so it improved up to that 99.203, which is kind of our new ceiling, and we have a floor at 98.716, which is a Fibonacci retracement. In times of great uncertainty, rising interest rates, and a rapid decrease in the dollar's purchasing power, it behooves investors to get their cash back in hand quickly as possible. So this kind of talks about why all this stuff matters. This allows one to redeploy their cash at a higher yield asset in a mad dash to hopefully check inflation's destruction of your capital. For mortgage investors in a time like now, with the aggregate prepayment speeds of both Ginnie Mae and Fannie Mae 30-year mortgages falling to the lowest since Duran Duran was making girls scream in the early 1980s, one source of relatively faster speeds are Ginnie Mae 15-year bonds. Besides being a nice port from the storm, should rates continue to ratchet higher, which we kind of expect the 30-year rate to go up higher and maybe hit 7% over the summer, the Ginnie Mae 15-year also tends to pay much faster than its conventional brethren. It's basically talking about why people might invest in different durations and different securities on this, because they want their money back when they think rates will be higher. That was from Chris Maloney at Bank of Oklahoma. We also got news that UWM Holdings reported Wednesday a $62.5 million net loss in the final 3 months of the year, including a $150.8 million decline in the fair market value of their mortgage servicing rights. So still way smaller loss than Quicken Rocket took, but is still profitable from operations, the CEO said. That's a free fall from the third quarter's $325.6 million profit and $239.8 million in the fourth quarter of 2021 when the market was still hot. The company reiterated its claim to be the industry's top lender, boasting 54% share of the wholesale market and 11% share of the market overall. The rest of us in the industry would point out that Rolls-Royce makes less cars than Toyota. Doesn't mean they're better cars. Doesn't mean that Toyotas are better cars.